I'm very grateful for the invitation to participate in what should be a very interesting panel on a very topical subject, the supervision of CCPs and the relationship between CCP supervision and financial stability. CCPs have always played a key role in safeguarding financial stability, and since 2012 have certainly delivered on their promise to manage risks in the most effective and efficient way. In fact, global derivative markets have since flourished thanks to this stable financial environment, supporting globally interconnected markets and providing benefits to participants from all over the world. We're convinced that global markets served by international services bring strong benefits to financial stability. And we're not alone. This has been recognised from the start, for example, by the G20 governments, as expressed in their communiqué, ensuring that the adoption of clearing mandates did not result in gaps, duplication, conflicts, or inconsistencies, which can lead to regulatory arbitrage and market fragmentation. The approach has been championed here in the EU via the EMIR equivalence decisions, allowing EU firms to access 32 CCPs that are established outside the Union. We believe that safe and sound markets need as diversified a set of participants as possible, all accessing global pools of liquidity. In other words, liquidity pools with global participation. In terms of CCP supervision, this is best supported by a global regulatory framework involving cooperation and coordination amongst all relevant local regulators and central banks of issue. That's good, because that's how we operate today. LCH Limited is directly supervised by authorities across the globe, including Reserve Bank of Australia, Bank of Canada, Bank of England, the CFTC, and tomorrow, ESMA and the ECB. We benefit from 13 licenses in various jurisdictions and from input of both EMIR and global colleges, as I mentioned. LCH SA is directly supervised by the AMF, the ACPR Banque de France, the CFTC, and the SEC. So we're supporters of cooperation and of strong involvement of regulatory authorities across jurisdictions wherever they have a strong stake in the effective functioning of the market in question. It worked like this today. It can work like this tomorrow. Why? Well, because this is the only way to manage risks associated with financial stability. It is the only way to ensure well-functioning, global, interconnected markets. It would be a mistake to think that market fragmentation is the solution to financial stability, in our opinion. So, cooperation is the key for supervision of vital market infrastructures such as CCP. It reinforces consistency, and it also helps to foster supervisory convergence, which is something our customers see as a priority. And it is equally valid for the supervision of EU CCPs and of third country CCPs. If we look first at EU CCPs, we're strong supporters of a more central role for ESMA and of a stronger involvement for central banks of issue on matters which affect the implementation of their monetary policy. So it's very good to hear that Fiona has no ambitions in that regard. We therefore naturally welcome the proposal of the Commission in this regard, and even more so the clarifications brought by both the Parliament and the Council in the functioning of this supervision. However, we believe that the supervisory solutions under current discussion can be streamlined. The text still separates day-to-day supervision, which will remain with national authorities, from structural decision-taking, which is in the hands of ESMA. This may create unnecessary tensions and delays. We believe lines of responsibility need to be more clearly defined. We think the adoption of supervisory decisions should be centralised, and we think there should be direct communication between the CCP and the authorities responsible for decisions governing its activities, namely ESMA. Better alignment between responsibility and accountability when it comes to CCP supervision would ensure a more efficient decision-making process. Now, moving on to think about third country CCPs, the logic is very similar. We support the direct involvement of EU regulators in the supervision of clearing services that are of systemic importance to the EU. As I mentioned previously, direct licensing, in our case, in more than 13 different jurisdictions, ensures the very highest risk management standards in the operation of our CCP services. CCPs like us, which have an internationally diverse membership, which benefit from cooperative supervision, and which involve wide-ranging coordinated resolution planning, represent a benefit to the wider system. They're better at absorbing shocks and better at preventing contagion. Customers recognise these qualities. This is why so many EU firms are urging the official sector to maintain a free choice of access. With this in mind, we're strong supporters of the following three things. First, direct registration with ESMA. Second, strong involvement of central banks on issues linked to monetary policy. And third, the establishment of EMIR colleges for third country CCPs. This is all in support of integrated global markets. However, we believe that cutting EU firms' access to global markets, especially on commercial hedging products that are traded globally, would increase rather than decrease systemic risk and would increase costs in the EU. EU firms must have access to global pools of liquidity to manage their risks in a safe and efficient manner. And it would be a mistake to think that they could do so efficiently by prohibiting access to such global pools. Constraining EU firms to using an onshore market in euros can only be damaging. This is where a denial of recognition, calibrated with reference to euro-denominated volumes, would take us. And it's tough to square a requirement to clear euro-denominated contracts executed by EU firms within the EU, while at the same time holding ambitions to strengthen the international role of the euro as a global reserve currency, which is as proposed in the State of the Union address last month. Denial by the EU of recognition to third country CCPs of substantial importance would, in our opinion, prevent EU market participants from accessing global pools of liquidity in which they can hedge their risk with all attendant efficiencies in terms of clearing and risk management. It would also affect EU firms' competitiveness, as they would be exposed to higher execution costs, increased systemic risk, and a weaker default management process. Our point is that denial of recognition would be disproportionate, given that, as per our prior comments, the clearing services provided by those CCPs would comply directly with EMIR and would be supervised directly by ESMA. There is no need to drive market fragmentation. Global integrated markets have brought great efficiencies to market participants, and customers continually express a preference to trade in them. Limiting EU participants' CCP choices and preventing them from accessing global markets and the corresponding liquidity and efficiencies there will give rise to costs and risks, and it will negatively impact EU market participants' competitiveness. Based on our experience of serving clients in multiple jurisdictions, a set of alternative arrangements could provide EU authorities with the tools to appropriately monitor the risks managed by third country CCPs pertaining to the EU marketplace. These mechanisms should build on two things. First, we have the proposals from the Commission This would involve the direct application of EMIR to systemic services operated by third country CCPs. And this should in turn lead to direct supervision of these systemic services by EU authorities. I think second, we can build on the proposals of the co-legislators, which is to say we should establish detailed cooperation arrangements covering all types of market events, including CCP recovery and resolution. It also caters for specific requirements of central banks of issue in allowing them to monitor risks linked to the transmission of monetary policy. In this way, safe and efficient risk management will be protected. So, we believe that the discussion has now moved to a more pragmatic stage focused on financial stability and the link to the transmission of monetary policy. We should continue this dialogue and focus on alternatives to simplistic solutions that would damage EU firms. Thank you.